Probably according to the pictures, yep. All right, everyone, we're almost done with Tokenize This 2026, but we're not done yet. There's more to go. We've covered a lot, again, over the years, over the 3 days, and over the years of tokenization that it's been around, right? Again, from payments and on-chain settlement, asset management, infrastructure, DeFi, legal conversations, and of course the builders in the room that have also been interacting with the institutions as well as with each other and other products. But it's enough of that. We've gone into the details, what works, what doesn't work. Now let's talk about what's to come. This conference is in June, the end of June 2026, and so it's a good way to maybe summarize what's happened and what we can expect for the rest of the year. So none other than our panel here, I'll hand it over.
Thank you very much. We have the unenviable task of being the anchor in a 3-day relay towards the end when everyone's exhausted. But I really appreciate everyone for sticking through it. I think this is the actual panel that's the most exciting, and you're going to walk away with the most information, and you're going to be glad you actually stayed till late Wednesday afternoon for this one. Before I continue, let me introduce my co-panelists. So my name is Emmanuel Aidoo. I was formerly the head of digital asset at Credit Suisse. I was the head of advisory for digital assets at Perella Weinberg, and now I've started my own consulting firm, helping everyone and anyone tokenize. I want to introduce my co-panelists, John, Khurram, and David. Do you want to introduce yourselves? Just give a quick background, and then we'll go into the quick round of questions. Do you want to start, David?
All right. Hey, guys. David here, founder of Inception Capital. So we started about 5 years ago. Previously, I was leading global strategy and investments at Huobi, which is one of the largest exchanges in the world before Binance and Coinbase came around. I lead early stage investing across mostly emerging markets for like fintech and crypto opportunities. And we also have a fund of fund that we invest in emerging managers as well across the stack in frontier tech verticals and also digital assets.
Hi everyone, John Delalio. I'm a partner at an accounting firm named EisnerAmper. I'm a partner in our digital asset practice. We've been helping clients in this space since 2018 with tax and accounting. Basically, we've survived the ups and the downs and then the other downs. It's, I think, a very exciting time right now because I am more based on the technology, and to actually see the technology being adopted and being innovated with the people in this room, I think is amazing. So very excited to be here.
Hi everyone, Khurram Dara. I think I can call myself a crypto lawyer. I've been practicing here in New York for a little over 11 years, coming up on 12 years. Started my career as a capital markets associate at a law firm, and in 2017 started working with a number of crypto projects that wanted to launch tokens. Dove in headfirst in 2018, joined an early decentralized exchange on Ethereum as their first legal hire, landed on the policy team at Coinbase in 2022, and most recently was at Bain Capital Crypto, a crypto VC where I led regulatory and policy. Just recently started up a new advisory firm, public affairs, product, and policy, along with several others called Thompson Street, and so I'm excited to be here, and thank you all for sticking around.
Well, as you can see, we have a really great panel of real experts, and you're going to be thrilled with their answers, I'm quite sure of it. So first question, I'm going to ask you 2 questions in one hit, just to kind of keep things moving, because we haven't that much time. But basically, I want to get each of you to give me like a 1-line temperature check on where the market is, risk on, risk off, and what's really happening. And then secondly, if you can hold the second question in your heads at the same time, it's like, what's actually happening or happened in the last 12 months? I want the real structural stuff as opposed to like, some proof of concept that someone's done somewhere. Do you want to start off, David?
Yeah, I mean, I think as a VC, we're always structurally risk on, but I think in terms of like where we're looked to get liquidity for our LPs is really risk off, right? So like there's not really much of a liquid market right now. There's tokens have to find a way to sort of evolve themselves to capture value. But all in all, I think it's a really good sort of price entry for us VCs to get in and finding sort of founders that are continually sort of long-term thinking about the space, and we want to be behind and backing those founders.
From my perspective as an accountant and what my clients are doing, To me, pricing is risk off. It's a distraction. It's a totally awful distraction. I don't really like looking at pricing every day, but I have to. It is what it is, but I think that's distracting from what's going on, which is the plumbing, the infrastructure of the technology, and I think that's risk on. The investment that's going into that space is smart money. It's solid investment backed with a plan that's going to deliver returns to investors. So I think that's where, I mean, the one thing caught my attention is New York Stock Exchange going on chain. Like, to me, that's a big signal. That's not noise.
Last but not least.
Yeah, John, I don't like looking at the prices either right now. Yeah, I think it's a bad market. It's tough if you're an investor. It's tough if you're a company and you've raised a certain valuation. I will say the one silver lining as a lawyer and working in policy that is nice is that sometimes it's not the worst thing in the world to be in this type of market when you have a lot of interesting regulatory and policy changes. It's not the worst time to build either. I think some of the tricky things is when you have a very hot market, you have sort of a whole nother set of risks from a legal and regulatory perspective. And so it's not a consolation by any means, because I think we'd all like to see the market up and to the right all the time. But it is one thing that is at least, with all the changes going on, it is at least a little bit comforting. And I will say, in terms of tangible change, I think when the new administration came in, the two things that I was looking at that a lot of other people were looking at too were, would you see more traditional fintechs, banks, and brokerages get involved in digital assets? And relatedly, would you see more M&A in the space? And I think both of those things we've seen quite a bit of, driven by some of the policy and regulatory changes.
I'm going to make you hold that thought and come back to you in a second on it. But before I do that, I want to ask John a question, which is, because you mentioned NYC, right? And infrastructure, and as an example, I want to dig in if that's the right example. If not, pick another. But what have you seen, like, as people have moved from pilot to production, and how has it really been driven? And then the second question will go to David. Off the back of that is the answer from a capital flow perspective? Is that what you're seeing as well, or are we seeing something different? In other words, are the examples matching up to where the money's going?
So we see our clients, I mean, there's been regulation change that's happened since the new administration came in. SAB 122 and ASU 2023-08 have just simplified how these assets can exist on a financial report. And I think from an accountant's perspective, that gives us great clarity. Don't use that pun, but I think the evidence is that there are companies that went public last year. There are companies that, like BitGo, went in 2026. We have Kraken lined up, blockchain.com lined up. I think the relevant piece of this is whether they're going public now or not is kind of a secondary thing. I get it, the market's off, want to see what SpaceX is doing. But if you look at how they are controlling their businesses and how they're reporting on it, it's surviving scrutiny. It's being signed off by auditors. Those companies are investing in the controls and the reporting and the interpretation of the regulations so that they are a valuable asset. And when I talk to other clients in the space, like investment bankers, they're looking down market for M&A roll-ups, and they're expecting that same rigor. So that market is also cleaning up their business with proper controls and reporting. Really important in a tokenization world, because at the end of the day, you want the technology tied to the thing, and you want to make sure it's tied to it. So I think that is where we are seeing our clients making investment. We also have a practice that does licensing for FINRA and SEC registration. That practice is going up. You have companies like Galaxy launching new products. They're getting passed. I mean, I live in New York. I remember when like Coinbase was the only exchange here that you could do business with. It was, do I move so I can, get on Binance, right? Like, that's all gone. So to me, that's where the investment is right now. The spot is awful. And I feel sorry for that side of the business, but the rails are being built for this industry right now.
David, you want to jump in?
Yeah, I mean, on the investment side, we see a lot of convergence in the U.S. on like where sort of policy is going. We'll have clarity coming up, but I think the bigger opportunity set is where we see in emerging markets where a lot of people are now taking in a lot of these stablecoin infrastructure and they're able to transact more efficiently than ever before. The volumes have skyrocketed across a lot of the major countries within LATAM, like Mexico, Venezuela, Colombia, et cetera. So there's a lot of really good opportunities to really reinvent the way that financial substack is being built within these markets. And all of this is being done in the post-AI era, right? When we think about all sort of the financial applications that we build today, they're all sort of pre-AI. Like all of these are very much built on very archaic rails. It's very much regulated by a lot of the regulations that still govern us. But when we think about a lot of these emerging jurisdictions, like the regulation is fairly wide open. People are very crypto native and they don't really have a very stable sort of native currency to their country. And they need all the best rails that are being run on all the sort of post-AI, very modern sort of financial infrastructure that they're able to transact and do business a lot more efficient than ever before. And that's like a 10x improvement in sort of their sort of current financial rails that they have.
While you have the mic, I wonder if I could double tap into your answer, right? Which is, because you talked about emerging markets and where the puck is going. Do you have a view or do you see a focus on a particular asset class within that context? And then, because I like to do my follow-up questions so people can hold it in their heads, once you answer that, I want to know what the accounting view is, if they actually are ready for that, and also the legal view, if we have the right infrastructure set up. So where are we going asset class-wise? What's going to be successful? And then is the accounting ready and is the law ready?
Yeah, I would say that like you can think about everything that's happening in emerging markets. Like what are some of the things that are lacking, right? First is like financial infrastructure, right? Second is financial access. And third is like financial literacy, right? So all of these things sort of combine to kind of have a new form financial infrastructure where people are able to do payments better. People are able to get access to U.S. equities and also U.S. treasuries, right? So I think a lot of what is really being built out is the tokenization and the payment side of things that is really getting a whole ton of adoption, and that all of it is built on stablecoin rails.
Thanks.
Yeah, my view is more in the United States as far as where my focus is. So, in my opinion, it's tricky. The money transfer licensing, the different regulations by state is a serious regulatory hurdle that requires a lot of time, energy, and effort. We do see clients actually going for it and making that bet or that investment. So I do see it becoming more the predominant. Well, everything's stablecoins, right?
The stablecoin question is next. You can do it now if you wish. It's like, hey, everyone kind of understands that people are queuing up to do it. The question is why. If there's a winner, are we ready? What's the real purpose? And then there is obviously a legal question around that too that we were discussing in the green room. So we can bring that both into this conversation. So yeah.
Yeah, I think my mind goes to stablecoins also. I mean, this is a tokenization conference. That's the original RWA that has clear product market fit. Let's get a bunch of the asset in one place. You have companies that are holding a bunch of treasuries, bank deposits, and then they're issuing tokens that represent that real asset. And we do now have a legal framework. About a year ago, almost, the Genius Act passed. Federal framework for both banks and non-banks to issue stablecoins. We're still in the process of getting rulemaking and having that being implemented, but I think it was a very positive signal. There's a lot of large companies, a lot of folks in financial services that look to a market having federal regulation as a kind of sign that they've arrived. And so I think that's helpful. On other types of RWAs, so tokenized securities, for example, that's a fascinating space because on the one hand, since you're conceding that the asset is a security, there is already a framework for dealing with securities in place. But what we see now is some of the internal plumbing, some of the rules I think recently of Reg NMS and the trade-through rule. I think it's Rule 611 that's it's being proposed that it may be rescinded or reformed in a certain way. These are certain technical rules that are difficult for a world of permissionless ledgers and smart contracts and composability to fit in, and I can explain that in a little bit more detail. But I think the legal and regulatory framework is catching up very quickly.
Do you think that in the context of, like, we're looking at, everyone's kind of waiting to see where we drop with the Clarity Act, for instance, and the different, we were talking earlier in the room, the Genius Act obviously did a really good job at laying the framework, and then smart folks like you, while you were at Coinbase, noticed there was a gap, and they missed out the word exchange. Do you think we close that gap, or do you think it kind of, where we are right now is where we are, and we get the legislation passed?
So I'm going to answer the question a little bit differently, because I think for purposes of this room, if you care about tokenization and RWAs, I actually think clarity is not the most important thing for you. I think clarity largely deals with how you're going to assign spot market regulator for assets that are not intended to be securities, that are intended to be commodities, primarily lots of other aspects to the market structure here. But when you're talking about, just take tokenized securities, for example, we already have a set of rules there, and so I think some of the regulatory changes are going to be more important. So for me, and I think this was maybe we're getting ahead of a question, but if I could pick sort of one regulatory or legislative item that I'm paying attention to that I think is going to impact the RWA market, that's going to impact tokenization, it's some of these rules, particularly Rule 611. So there's a rule, an SEC rule called the trade-through rule that says exchanges need to route orders and make sure that there's no inferior execution. Basically, if there's a better price available somewhere on another exchange, the exchange needs to be able to plug into that and offer that to a customer. It's actually a very controversial rule because even back in 2005 when it was proposed, Chairman Atkins now was a commissioner at the SEC. He dissented, and the criticism was that by forcing that rule, there may be some exchange off in the distance with not a lot of liquidity, and now you're forcing an exchange to plug into that. Maybe you're revealing something about the price. It may not be appropriate given the size of the order. All of that is relevant to the discussion around tokenization, because if you want to have composability, if you want to have the ability to use tokenized securities with DeFi protocols, an AMM, an automated market maker, a liquidity pool, there's literally no way for it to plug into a bunch of other exchanges to confirm whether the price is inferior. It would be in violation of the rule all the time. So getting that rescinded actually is a huge unlock, because now you have the potential to have a tokenized security that plugs into an AMM potentially, and really you get to leverage the benefits of the technology.
Well, and I'd just say to support what you're saying, I read an interview with Commissioner Hester Pierce this week, and she said verbatim what you said is that clarity will make no difference to tokenization. So you all should be very excited about that. And I think the one issue you're pulling out is the issue affecting this room.
So, David, where's the capital flowing to right now? If it's rotating at all, US out to Asia, where do you see it? What projects? Do you agree with your esteemed panelists to your left?
I think, at least on the venture side, the capital is still flowing to the best of the best founders, right, that are thinking very much long term about the market and kind of have a good sense of like where not only the regulatory framework is going, but like where the biggest amount of traction is going. And not to iterate on this more, but I think there's a lot of really good opportunities in the emerging markets, and that's not only being captured by sort of the local founders within, whether it's LATAM or Southeast Asia. It's actually a lot of sort of the best developed market entrepreneurs, whether they're in the US, whether they're in China, they're now flocking to build different rails within these emerging markets. So even the best of the best founders now are realizing that really the opportunities to iterate, to innovate, and also to get traction is within not really in with their home market, where it's still pretty heavily regulated. And so they're going south to some of these emerging markets to build, and we see there's a ton of opportunities there.
And I guess the question comes to you, John, right? Because you've got clients Just heard my voice turn up. You've got clients that I'm sure are focusing on similar things, right? So where do you see like people focusing their attention and their energy as they think about 2026, 2027?
Actually, it's interesting because you heard me say it before, they're focusing on the technology. So we have clients who are level ones or protocols that are pivoting their models, that they had something and now they're changing.
Why?
Probably to be more aligned with payment, finding liquidity, generating yield. Like the technology was created, a few years ago. It had a cool buzz. You could get a valuation just because, Shiba Inu. Come on, you didn't have to do anything, and you were valuable. But there is some good technology out there, and I'm seeing some of the L1s and protocols are actually pivoting their models to be much more focused for a specific need in the industry. So that's one area where I think it's really interesting. There's some
Do you have any
roll-up
specific
going on.
examples of that?
What's that?
Do you have any specific examples?
Polygon, Hashgraph, all of them have gotten very succinct in their new focus, right?
Agreed.
The other thing I think which is kind of interesting is that in tokenization in particular, we talk about stablecoins, we talk about tokenized securities, but then there's the third bucket of everything else, right? And we're seeing some really interesting concepts happening there. So you hear everybody talk about tokenized real estate. I think tokenized real estate is really hard to do. People who are making progress there, hats off to you. Real estate's hard to do even if you're not tokenizing it, right? So what we're seeing some of our clients do is we have one client that's doing a tokenized gold fund. It's a very simple commodity. They've got a means and a mechanism to provide a token that's tied to a physical asset that's auditable. They're now going to take it into other commodities. There's another company who was here earlier where they're tokenizing Canadian mortgages. Again, trying to take a bizarre, generating asset somewhere and putting it on chain. We'll see how the secondary markets react to those things. I don't think the secondary market's there yet, but I love the investment in what they're looking at with the technology and tokenization. I don't know, if anybody went to Consensus like 3 years ago, it was like, it was nothing like it is now. Now it was all major financial institutions, rails, and tokenization. That's what it was this year.
Question for all three of you. From each of your own perspectives, or a different perspective you choose, right? But what is the market underpricing right now? And actually, conversely, what are they overpricing?
What was it?
What is the market underpricing? So what are we not focused on that's the area that people aren't watching, or what is the area that people are over-focused on that actually isn't a big deal? I think I've heard Khurram's view on that already. For over-focus on Clarity Act, not focusing on much on Reg NMS. That would be
I can give one more also. I do think it's escaping me as I'm saying it right now. You'll come back to me for it. I'll remember. I lost the thought.
John, you go next.
Yeah.
You got
I'll
one?
start thinking about the other thing you mentioned.
No worries.
Yeah, before we got on.
Yeah, go for it.
Yeah, I think it's all the tokens that have fundamentally really good revenue streams, right? That they're growing and compounding quite efficiently, but just there's no liquidity in the token market, so a lot of these are being quite underpriced, particularly in sort of the DeFi segments. There's a lot of really good lending protocols, a lot of good tokenization platforms. So I think all of these that have sort of true revenue drivers are being very much underpriced.
David, you jog my memory. Lending protocols. That DeFi lending, vaults, this is an area that is huge, but unlike other huge areas in crypto, so think trading, think stablecoins, the regulatory environment and the policy development in this area is not nearly where it is in those two other areas. We already have a federal framework with Genius for stablecoins. We have clarity for market structure, and even if it doesn't pass, we have kind of a general sense of what market structure regulation will look like. Lending is a huge area with a lot of potential touch points to the regulatory perimeter that is just not nearly developed, and I think it's an interesting space because my understanding is broker-dealers, for example, have a very lucrative lending business as it stands now, where they're sitting in between a lot of retail and their securities, and they're able to lend out securities on behalf of customers. I think that's an area where you could see a lot of potential opportunities with RWA and tokenization.
John?
Yeah, I would absolutely agree with you. To me, the technologies are now allowing for faster flow, different ways to collateralize things in a safer risk profile. A lot of innovation going out there. It's difficult transactionally. Lending and borrowing is a big deal. It's hard to do, but I think it's happening. I mean, it's really a big part of what digital assets are all about.
So I guess the follow-up question would be, as we think about these asset classes, where do we think the next institutional dollar is going? This whole panel is around kind of the future, and I spent most of the time asking you about the present. So really, I'm going to just kind of pivot you a little bit and be like, okay, where are we going? If everyone's pushing really hard through the stablecoin door, and that's payments, right? I guess I'm asking the DVP question because not everyone's doing, PVP. So if you want to have a stable coin and you want to use it for something useful, 90% of things that we use payments for is to buy something. What are they going to be buying?
Well, for this room, I would say one hope is that they're buying tokenized equities.
Oh, yeah,
right?
equities.
So, yeah, equities
right.
specifically. And I think that for me, like forward-looking vision, I think we had folks here from DTCC, and I think somebody was here from Securitize as well, and I think Robert Leshner from Superstate was here. I think it's really interesting if you think about where institutions are going. Like I think there's two visions of what tokenized equities could look like. There's a kind of DTCC version of it, and then there's a more transfer agent heavy version of it. And the reason I say that is, historically, if you go back to the creation of centralized clearing and settlement in the late 60s and the 70s, that was actually intended to be a kind of temporary solution where you house all of the physical stock certificates in one place, and you use a book entry system. The thought was eventually we wouldn't have physical certificates at all. And you can go back to the congressional record. There were debates about this. Maybe instead of centralized clearing, we should have a decentralized network of transfer agents. And this is from the 70s they were talking about this. The concern back then was the technology was not where it is today, and central clearing was something that the New York Stock Exchange was doing that was in practice. It wasn't a pilot, it was in production, and that's where things went. And so for me, there's been all of this legacy, these legacy institutions have consolidated. It wasn't the case that there was only one clearinghouse and one depository in the 80s. There were several of them. Now everything is basically DTCC and NSCC and everything under the depository trust company. And so I do think it's interesting to see, like, will the legacy incumbent players try to keep the sort of market structure the same and add the ledger as a kind of more back office composability improvement, or do you actually see like a different shift in the market structure where I think like there's a world where the transfer agent actually is the doing a lot of what DTCC does today. Yeah. So that's where my head's at.
Anybody else?
So I guess what I would say is, I hate to be the one that says this, but like to me, agentic trading is not here. Everybody's talking about it. The concept that you could put together new financial products with very unique and variable risk profiles and automating all of that, I think is huge. As I said before, the New York Stock Exchange, NASDAQ, both going on blockchain rails is huge. As we were talking about, I think AI is scavenging investment out of this space, which is a bummer. But also, I don't think that space can exist without blockchain technology, blockchain ledgers. Robots are not going to exchange crumpled dollar bills. They're going to be sending digital currencies.
Agreed.
So that's one area where I think it's coming. I don't see it coming immediately. There's a lot of talk about it. It's not here yet. I think you also have prediction markets that are wound into that as a whole nother ball of wax that we'll probably be talking about next year. So there's a lot going on there. Now, you had an interesting perspective on offshore relative to digital assets. Can I throw a question back to our moderator?
You can throw anything back you want to me. Go for it.
Well, I was just, your point was that the stablecoin overseas, the investment overseas, kind of changes the market. It's not so much, it's been said here throughout the week, it's not so much about US, it's about planetary.
As a rule, as a moderator, I try to make sure that my co-panelists get all the speaking. And anyone who knows me, and I know Paul over there knows me really well, this is a real test of my will to actually shut up. So thank you for letting me speak. Yeah, so I think that there is more than a conspiracy theory when I think about the largest stablecoin issuer on the planet, Tether, having outsized treasuries than some of the sovereign governments that own US treasuries. So at the very time when structurally countries are buying less treasuries, you've got private companies like Tether who own more of it. And then I think about who are the biggest funders of Tether and where they sit and live today. And it doesn't take a lot of genius, pardon the pun, to figure out where the puck is going. I won't say more than that. I shared more in the room. But I can see where the puck is going with this thing. And it's actually a really interesting play because of what it means is that the US government can continue to issue treasuries, have a captive market in retail outside of the US and still control money supply, which is the whole point of the US dominance. So that's, I think, the real crux of it. And when you think about the macro picture, I think you mentioned something super interesting as well around AI, and I think we have to all focus on what does AI trading look like? When do we get to a recommendation to a trade, and how does that play out? So I think we will be talking about that, and we'll be talking about things with respect to prediction markets, probably before the end of the year, to be fair.
Yeah, I think on my end, it's like really improving the financial literacy of everyone sort of in the world, right? I think with sort of the ChatGPT moment for us is really being able to understand pretty much everything there is to know about the world, less so on the financial market side. So like really having an agent that not only trades for you, but kind of is able to really teach you about everything that's happening within the financial market, whether it's investing, whether it's balancing your portfolios, whether it's asset management, whether it's how you can able to really just become a more sort of financial savvy person and be able to then make sort of the right financial decisions that's right and risk curated for you, right? So I think ultimately when that time period comes, there will be a whole slew of sort of products that gives not only the financial literacy to people all across the world, but also now having sort of the tokenized structured products that then give sort of the financial access to the rest of the people, so that all in tune, people will be able to take whatever money they earn, but be able to sort of compound it in the way that they're comfortable with.
Fantastic. So I've got my last question for you guys, and then if you want, I'll take the audience question if there is one. But one question for you guys: we talked a lot about the positives, right? Where the market's going. If I gave you $100 each and say bet against one thing, I bet your answer will be bet against tokenized real estate. But if I was to say bet against one thing, what would it be? You can go first, Khurram. Yeah.
If I could bet against one thing.
I stumped them because this wasn't the question that they got.
I used to be one of those people that thought that tokenization was going to be very useful for private markets, for private securities where there's not a lot of liquidity. It's difficult to discover counterparties. I've now kind of come around to the opposite view on that. I'm not so sure. I think there may be some benefits. Obviously, like doing a secondary on Carta is all effectively electronic already. Maybe there's some benefits of doing it in the tokenized version. But I'm not betting on private securities being tokenized. I think companies want to be private for a reason sometimes.
That's a fantastic answer, by the way. I would have done that one too. Go ahead, John.
I guess on a similar vein, I hate to say it, but having done a lot of work in real estate, to me, it just does not seem like an industry that will lend itself to that sort of automation and efficiency. I think real estate survives in a part of our society where it's a lot of information that isn't publicly known. And that's how people make money. And if it's on chain, I think that changes the dynamic. So I'm not.
Yeah. Okay.
That'll be mine.
Yeah, I think ultimately a lot of people are very much over-indexed on like the AI equities beta, right? Like everyone is consuming so much of the market cap of sort of the world that like I think there's a time period where there might be a big bubble coming and there's going to be some level of correction that's going to be ahead of us. So I'm not saying that I'm sure AI long term, but I think just where sort of where some of the money is being put forth, it just seems like a very frothy environment right now.
Fantastic. Thank you very, very much. I really enjoyed the answers. I've learned a lot, by the way, from this. I shared questions with these guys over the weekend. They told me to include any question I wanted, which I did, and I threw that last one in there just to trip them up. After I told them in the room I would not trip them up, but you did fantastic. Would you join me in a round of applause for the last panelist? Thank you. Thanks, guys. Really appreciate it.
Thank you.